Hi everyone. This is Dao Chai. Um, I'm at the university library right now, so sorry if you guys hear students in the background talking. But we are going to be looking at current liabilities, accounts payable. Okay, I want to start off with a little inspiration by Anne Frank. How wonderful it is that nobody needs wait a single moment before starting to improve the world. So the FASB, the Financial Accounting Standard Board, uh, conceptual framework defines liability as probable future sacrifice of economic benefits arising from present obligation of a particular entity to transfer asset or provide service to other entities in the future as a result of past transactions or events. Um, there are three characteristics that are essential. Um, it is a present obligation that entitles settlement by probable future transfer or use of cash, goods, or service. Second, it is an unavoidable obligation. And third, the transaction or events creating the obligation has already occurred, right? So the underlying concept to determine the appropriate classification of specific financial instrument company needs proper definition of asset, liability, and equity. Often use the conceptual framework definition as the basis for resolving controversial classification issue. Because liabilities involve future disbursements of assets or service, one of their most important features is the date on which they are payable. Right? A company must satisfy current maturing obligation in the ordinary course of business to continue operating. Liabilities with a more distant due date do not, as a rule, represent a claim on the company's current resource. There are slightly different categories. This feature gives rise to the basic divisions of liability into a current liability and a long-term debt. All right, so here are some of the current liabilities. What we're going to be looking at is accounts payable, but we also have no payable dividends, customer advance and deposit, unearned revenues, sales tax, income payables, employee liabilities, current maturity of long-term debt, and short-term obligations. Um, so those are some of the current liabilities. So our current asset are cash or other asset that the company reasonably expects to convert into cash, sell, or consume in operations within a single operating cycle or within a year. Current liabilities are obligations whose liquidation is responsibly expected to require use of existing resource properly classified as current assets or the creation of other current liabilities. This definition has gained wide acceptance because it recognizes operating cycles of various lengths in different industry. These definitions also consider the important relationship between current asset and current liability. The operating cycle is the period of time elapsed between the acquisition of goods and service involved in the manufacturing process and the final cash realization resulting from sales and subsequent collections. In industry that manufactures products require an aging process, and certain capital-intensive industry have an operating cycle of considerably more than 1 year. On the other hand, most retail and service establishments have several operating cycles within a year. So accounts payable or trading accounts payable are balance owed to others for goods, supplies, or service purchased on open accounts. Accounts payable arise because of the time lag between the receipt of service or acquisitions of asset and the payment for them. The terms of sale, 210, net 30, or 110, or end of month, usually states the period of extended credit, commonly 30 to 60 days. So most companies record liabilities for purchase of goods upon receipt of goods. If control has passed to purchaser because receipt of goods, the purchaser should record the transaction at the time of transfer controlled. So a company must pay special attention to transaction occurring near the end of the accounting period and at the beginning of the next. It needs to ascertain that the records of goods received, the inventory agrees with the liability, accounts payable, and that it records both in the proper period. So goods includes an inventory. A company recognizes inventory and accounts payable at the time it controls the asset. For example, we're going to use Verizon. Purchases Apple watches for resale. Verizon records these watches as inventory at the time control passed to Verizon. Control is therefore the key factor in determining when purchase and sales of the products are recognized. Right, the FASB, the Financial Accounting Standard Board, indicates that Verizon controls the Apple watches when it has the ability to direct the use of and obtain substantially all the benefit from these watches. Control also includes Verizon's ability to prevent other companies from directing the use of or receiving the benefits from these watches. So passage of title is often used to determine control because the right and obligations are established legally. So again, Verizon purchased the Apple watches. Legal title belongs to Verizon until sold to customers. Right, so IFRS, the international, right, standard, and GAAP for inventories is essentially the same. So for goods in transit, in this situation, companies generally determine control based on who owns the legal title to the goods by applying these passage of title rule. So if a supplier ships the good, so we gotta look for this, right? We're using Walgreens as an example. So you'll state Walgreens FOB shipping point. Now that pass title to Walgreens when the supplier delivers the goods to the common carrier who acts as the agent for Walgreens. Now, and then if the supplier ship goods FOB destination, so it's, see how similar it is? So FOB destination title pass to Walgreens only when it's received the goods from the common carrier shipping point and destination. So often designate by a location, like for example, FOB Denver. Okay, so we got to be careful with that. So when Walgreens obtains legal title to goods, it must record them as purchased in that fiscal period, assuming a periodic inventory system. So thus goods shipped to Walgreens FOB shipping point, that's the one we're going to use, but in transit at the end of the period belongs to Walgreens. So it should show the purchase in its records because legal title to these goods passed to Walgreens upon shipment of goods, right? To disregard such purchases result in understating inventory and accounts payable in the balance sheet and understating purchase and ending inventory in the income statement, so we have to be careful with that. Yeah, so treatment of the purchase discounts. So the invoice received from the creditor specifies the due date and exact outlay in money that is necessary to settle accounts. So the only calculation that may be necessary concerns the amount of cash discount. So the use of purchase discounts in a periodic inventory system identifies that the company is reporting its purchase and accounts payable at the gross amount. So we're using the gross method, okay? If a company uses this gross method, it reports purchase discount as a deduction from purchase on the income statement. So this is how it's going to look like, right? So we purchase costs at $10,000 for a term of 30. So the purchase is for $10,000, and then we got accounts payable. We credit that for $10,000. So we got purchases, debit 10, accounts payable, credit 10. Now, how it's going to look on our next entry for the invoice. So here comes the invoice of $4,000 are paid within discounted period. So it's going to look like accounts payable. We're going to debit $4,000 for accounts payable for that entry, and then we're going to have purchase discount for $80. We're going to credit that in the purchase discounts subsidiary account. Then we have cash, which we're going to credit. So that's going to be $3,920. So that's how that's going to look like on the discount period. And then we get another invoice of $6,000, and we pay that after the discount period. So this is going to look like accounts payable. It's going to debit $6,000 out of that, and then cash, we're going to credit $6,000 for cash. So that's how the gross method would look like for purchases discounts. Okay, thank you.